Hi guys, welcome back to the channel. Qualcomm's stock price skyrocketed after the earnings release last week. Qualcomm's press release told a story of growth both on the top line and bottom line. They used the non-GAAP earnings per share numbers that showed growth, and the story of robust growth continued with the next quarter's guidance rising even further. Revenue is expected to rise to $10 billion and non-GAAP earnings per share to 290. The markets cheered and the share price jumped with a big gap up and a long candle to close at 163. But in fact, Qualcomm had a mixed quarter, with revenue rising 12% year over year to $9.3 billion and the net income and earnings per share dropping 5% year over year to 245. So is it a good time to invest in Qualcomm or is it a time to offload? Let's dig into the numbers starting with the income statement. The revenue is on a rising trend and management is expecting further growth in the next quarter. The year over year revenue is expected to grow by 21.4%. The cost of revenue is also spotting a rising trend, and that is placing a cap on the gross profit. It is not showing the same kind of jump that we saw in revenue, and the gross margin is also flattish, but it is a strong margin at 57.8%. As we go down the income statement, the R&D costs have also increased rapidly in recent quarters. That has resulted in a drop in operating income to $2.9 billion from last year's $3.5 billion. There was a gain on investment of $521 million. It is a sizable amount and helped to push up the net income to $2.8 billion. If this gain is omitted, the net income would have come in at $2.3 billion, a big difference from last year's $3 billion. The net margin is again strong at 30%. The earnings per share came in at 245. Similarly, if the gain on investment is omitted, it would have come in at $2 only. At the current price, the PE ratio is 20.7 and pushes Qualcomm into the overvalued region. The operating cash flow dropped from $1.1 billion, and after taking away capex, the free cash flow was $647 million, a far cry from last quarter's $2.9 billion. So the story is not so rosy anymore. The objective of any business is to make money. What is the point of celebrating the top line when the free cash flow is taking a hit? I also don't like the way Qualcomm is allocating its capital. They have a massive debt of $15 billion, and instead of paying off the debt, they are giving out dividends and buying back their shares. Dividends and share buybacks are a further drain on their cash position. The result is declining liquidity. Qualcomm is highly likely to take on more debt in the future to service its working capital. Qualcomm's balance sheet is not that great either. As an overview, they have a total asset of $41 billion versus liabilities of $31 billion. The goodwill makes a big chunk of their assets at $7 billion. If the goodwill is taken away, the total assets will drop to $34 billion. On the liability side, they have a long-term debt of $13.7 billion and another short-term debt of $2 billion. Qualcomm is a strong 5G player with high gross and net margins. But while the revenue is growing steadily, the net income and free cash flow are coming under pressure due to increasing operational expenses. Qualcomm also has a huge debt that they don't seem to be interested in paying off anytime soon, making it a risky investment. The valuations are high with high PE, PEG, and price to book numbers. On the technical side of things, Qualcomm is well supported at 122, and there is an overhead resistance at 170. It is not wise to invest in Qualcomm at this price nor at this time. I will have to pass Qualcomm for other tech companies that present a better risk reward ratio. Speaking of which, do check out my other videos here. If you have found this sharing useful, please consider subscribing. It will help to grow this channel further. Thanks for watching, and I'll see you in the next one.